Venture capital is about investing in businesses that have the potential to scale exponentially, not just incrementally. While the strength of a startup's product, the capabilities of its team, and the quality of its execution all play a crucial role in its success, the real determinant of whether it can deliver venture-scale returns is the size and dynamics of the market it operates in. Investors don't just look for great products, they look for great products in markets that are massive and expanding rapidly. The real question is never just whether a company has built something innovative or useful, but whether it has done so in a space that can sustain a billion-dollar business. To evaluate a startup's potential, venture capitalists dive deep into the market landscape. They analyze how big the opportunity is, how fast it's growing, and how competitive it is. A brilliant idea alone won't be enough if the market is too small, stagnant, or oversaturated with competition. On the other hand, a startup entering an industry that is expanding rapidly, especially one with few strong competitors or a clear path to differentiation, has the potential to generate extraordinary returns. One of the key ways investors assess market potential is through what's known as Total Addressable Market, or TAM. This is the total revenue opportunity available if the company were to capture 100% of its ideal customers. But to get a clearer picture of what a startup can realistically achieve, TAM is further broken down into layers. The SAM, Serviceable Addressable Market, represents the portion of TAM that the company can feasibly serve, considering factors like its geographic reach, business model, and distribution capabilities. Even within that, the SM, Serviceable Obtainable Market, reflects the market share the company is actually likely to capture, taking into account competition and execution challenges. To understand why this matters, consider a startup developing AI-powered accounting software for businesses. The global market for accounting software might be worth $100 billion annually, but if this company is targeting only mid-market and enterprise customers, its realistic serviceable market is closer to $40 billion. If it can capture just 5% of that over 7 years, it could be generating $2 billion in annual revenue. That's the kind of scale that attracts venture capital investment. Even capturing a small slice of a large and expanding market can create a billion-dollar company. But a large TAM alone isn't enough. What matters just as much is whether the market is growing. A massive but stagnant industry doesn't create exciting opportunities. Investors look for markets with strong compounded annual growth rates, or CAGR, often above 20 or 30%, because this indicates strong tailwinds that can fuel rapid adoption. They also seek out industries undergoing significant disruption, where shifts in technology, regulation, or consumer behavior open the door for new companies to reshape the landscape. Emerging trends such as artificial intelligence, cloud computing, remote work, and ClimateTech are clear examples of markets experiencing sustained expansion. A great illustration of this is the taxi industry in the early 2000s. It was a large market, but it wasn't growing. Then ride-sharing technology arrived, transforming the industry overnight. What was once a mature, slow-moving space suddenly became an explosive, high-growth opportunity, leading to the success of companies like Uber and Lyft. This same kind of transformation is happening today in sectors like artificial intelligence, AI, deep tech, and climate tech. These are fields that not only have a large TAM, but are also expanding year after year, drawing the attention of venture capitalists eager to invest in the next big wave. Even when a startup is in a large, fast-growing market, competition remains a critical factor. Investors evaluate whether the space is already dominated by powerful incumbents, whether the startup has a clear point of differentiation, and whether there are barriers that can prevent new entrants from simply replicating its model. The presence of competition doesn't necessarily mean failure, but it does mean the startup needs a significant edge. Some of the most successful startups in history have found ways to break into competitive markets by offering something fundamentally different. Tesla didn't just enter the crowded auto industry, it built an ecosystem around electric vehicles and superior battery technology, creating strong brand loyalty in the process. Slack managed to thrive despite Microsoft's dominance in workplace communication by focusing on an intuitive, team-friendly experience. Stripe became a leader in payments not by inventing something entirely new, but by making developer integration radically easier than what legacy providers like PayPal offered. Investors look for startups with this kind of defensible advantage, something that makes it difficult for others to copy their success. But not every market is worth investing in. Experienced venture capitalists quickly spot red flags that suggest a startup is unlikely to scale. One of the biggest warning signs is a market that's simply too small. If the total revenue opportunity is only a few $100 million, even an extremely successful company won't generate the kind of returns that venture investors need. Declining industries are another major concern. If a market is shrinking due to technological obsolescence, shifting consumer habits, or regulatory challenges, the risk of failure increases dramatically. Even in a promising industry, too much competition can be a problem. When dozens of companies are already fighting over the same niche without clear differentiation, it becomes difficult for a new entrant to gain traction. Another common red flag is an over-reliance on a single type of customer. If a startup's business model depends too heavily on a small group of enterprise clients or a narrow demographic, it may struggle to scale beyond its initial base. For startups looking to attract investment, being able to defend their market opportunity is critical. Investors want to see hard data, deep customer insights, and a well-thought-out go-to-market strategy that addresses these risks head-on. At the end of the day, even if a startup has an incredible team and an innovative product, venture capitalists ultimately invest in markets. A great team in a bad market will struggle, no matter how skilled or experienced they are. Conversely, an average team in a huge, high-growth market may still find success simply by being in the right place at the right time. But when a truly exceptional team enters a large, expanding market, that's when billion-dollar companies are built. Investors are always searching for those opportunities, businesses that are positioned in markets that are big, growing, and ripe for disruption. That's where the best venture returns come from. There's a saying in venture capital that sums it up perfectly. When a great team meets a bad market, the market wins. When a bad team meets a great market, the market still wins. But when a great team meets a great market, that's when the magic happens. For venture capitalists, investing isn't just about great ideas. It's about great ideas in massive, fast-growing markets. Startups that thrive have not only a strong team and product, but also operate in industries where demand is rising and disruption is possible. Investors avoid markets that are too small, shrinking, or overcrowded without differentiation. The best returns come when a high-caliber team enters a large, expanding market with a defensible advantage, creating the conditions for billion-dollar outcomes. As the VC saying goes, when a great team meets a great market, that's when the